So let us analyze what is the purpose or need of debt. So usually debt is required for acquisition of assets. Basically assets which are of appreciating in nature. It means the value of the asset keeps increasing as the year passes by. A very good example of such asset will be a real estate or a house or any commercial property which you buy. So they all comes under the appreciating asset. The second reason may be purchase of house, as I just said. And there is something called as discretionary and luxury items. Discretionary items are those items uh, which may not be a necessity, but generally it can be a luxury item. So those are called as discretionary. You have the ability to decide whether to buy it or not is called discretionary. The absence of that particular item will not affect your day to day life. Like car. So car is a discretionary item and is a luxury item. Absence of car will not be of any effect to you because there are other means of transport like bus, train, metros in big cities. So those are not going to affect your daily life. Definitely, food is not a discretionary item; is a necessity. You require food. Similarly, water is a necessity. So these are all house is a requirement, is a necessity. You should have something to stay. So these are all necessities. Whereas car, diamonds, TV, fridge, they are all discretionary item. It will not really affect your daily requirements for your survival. So we have understood what is discretionary item and what are luxury item. Now, some people will take loan for providing higher education to the children, their sons or their daughters. Some people take loan or they raise debt for some health issues also, even though it is rare, but it happens. See, we have to understand that debt is always not bad. Suppose if you have raised a debt at a particular interest rate, but the asset which you have purchased, the value of the asset increases faster than the interest rate which you are paying, then in such case, debt is not bad. Debt will be a positive thing in your financial planning. The second thing, very important thing is the individual who is raising a debt or taking a loan should have the capability to pay back the loan. Servicing the loan means servicing the debt means he should have the capability to pay back the loan. So what will be the impact of debt? See what impact it will have on your life, on your finances. See, the acquisition of the cost of the property or assets, whenever you buy house on loan versus you are having some amount of money and you have down made the complete down payment and paid the money, there will be a difference. If you pay the complete money, the cost of acquisition will be less. But if you are purchasing a house on loan, the cost of acquisition will be higher than paying the complete cash and purchasing a house. It is understood that not every people will be able to buy a house making full down payment, and some people raise the loan to purchase a house, but they should be very careful at which place they are purchasing a house. Some people buy a house or buy a flat for the purpose of investment. So you should be very careful while doing all this, because there should be some amount of the locality in which you are going to purchase. So those localities are very important because it should be an appreciating asset. You should not buy a house in a very remote area where there will not be any gains in terms of rental pay or appreciation in the asset of the value of the asset. Okay, that is very important. If the appreciation of the asset is higher than the interest which you are going to pay, then it makes sense to buy a house, whether for your own stay or for the purpose of investment. Now you have to consider a very important concept called as debt to income ratio. So if you are taking 20 lakh loan and your annual income is about 10 lakh, so your debt to income ratio is 2. So what is being told is, when you raise the debt, you should keep your debt to income ratio as low as possible. Now coming to the two important concept, that is consumption expenditure and investment expenditure. Let us list out these two. See, consumption expenditure are those expenditure, once you invest the money in those expenditures, those type of consumption items, you are not going to get any returns out of it. For example, if you go to a restaurant, you are not going to get any income out of spending money in a restaurant. If you go on a foreign trip and you come back, see, materially it is going to increase, give you some satisfaction. You went and saw all the places, that is all fine. But financially, if you go on a foreign trip and if you spend 10 lakh on a foreign trip, that is not going to give you any return. Similarly, going to a restaurant will not give you any return. So consumption expenditures are those which does not generate further income. Now, there are certain daily need expenses like food, beverages, electricity, house rent. These are all necessities which you cannot avoid. But still, they come under consumption because they are not going to give you any returns. So they are also a form part of the consumption expenditure. But they are necessities. They are not discretionary. You have to have food, you have to have electricity, you need to have a house. So these and they need to have a health insurance. So these are the important points which goes in the consumption list, but they are important in your life. Now sometimes there is, you have to maintain a particular lifestyle. So this lifestyle expenses, even though it is discretionary, but sometimes you may have to incur some expenditure on that. So that is known as lifestyle expenses. Expenses on education. See, it is, there will be a debate, if you expend money on the education. First of all, when you get education, you can earn more money by getting a better job. But at the same time, at any particular point of time, when you have invested money in the education, when you have paid the fees and all, that is not going to financially generate any income to you. So education expenses comes under the consumption expenditure. Okay. Now what are the investment expenditure? Suppose you invest in public provident fund, you invest in a fixed deposit, if you invest in like post office scheme, RBI bond. So these are all investment expenditures. Okay. These expenditure will give you return. Public provident fund will give you return, NPS will give you return, post office schemes also give you regular returns. Now let us come to the another concept, what is called as identifying the holes in the household budget. See, what are the important point you should consider while making a household budget. See, what is generally told is, if you you should decide what expenses you should note down. Some people say, if I expend more than 500 rupees, I will make a note of it. Anything below 500, no need to note down. But some people may have the capability to say that they will generally note down any expenditure above 1000 rupees. So these type of things, first of all, you should decide whether you would like to note down any expenditure below 500, above 500, or above 1000. That threshold limit you have to set for yourself, and make a journal of expenditure incurred every day, whatever threshold you have set. The second important aspect is to reduce the debt or the requirement of loan is, you should be very very careful while putting your money in discretionary expenses like car, TV, fridge. See, there is a TV which will be 5 lakh TV also. The same work will be done by a 2 lakh TV also. Similarly, you can have have a mobile like I will not name the product. Some mobile are very costly. Is it really required? And what is the requirement for a very costly mobile? If you are just doing the normal things like making a call or seeing WhatsApp, I don't think you really require a very costly mobile. So these are all things you should, set yourself. Just for the purpose of showing, you should not buy an iPhone or any costly mobile and flaunt it. At the same time, there are people who nowadays generally people are taking loan to buy a iPhone. Those are all can be avoided, and those people generally land in a debt trap, and they suffer at a later stage. Now, the next concept is leverage and debt counseling. What does it mean? Let us understand. See, generally the purpose of the debt will be for appreciation, buying appreciating assets, and you to purchase high cost high household necessities. You know what are the high cost household necessities? I have already explained: fridge, TV, and all, and education and upskilling. Okay, now the cost of debt will be in the form of interest rate which you have to pay for the loan or debt you have raised or you have taken. So the interest rate depends upon whether you have taken a personal loan or a housing loan or a car loan. So generally for housing loan the interest rate will be less, but for personal loan and credit card loans, credit card will be very expensive. You should avoid taking loan on credit card or buy anything from the credit card. Now, the maturity of debt. See, there are various types of loans: short-term loan, long-term loans, which will be available. Uh, loans will have a tenure of 1 year to 25 years. That depends upon your repayment capability. You can raise a loan for 10 years. Some people will raise a loan for 5 years. So it all depends upon what is your repayment capability. So this is, I have already explained, there are long-term loans given by the banks. See, what happens is if you take a short-term loan, you have to repay, the repayment amount per monthly will be higher compared to the long-term loans where your repayment amount will be less. But short-term loans will have less interest rate, whereas long-term loans will have higher interest rate. So you have to understand this. Now, we will understand what is debt rescheduling. So, what do you mean by debt rescheduling? Debt rescheduling means you pay, the higher interest rate debt by raising a lower interest rate debt from some other bank. So, in order to do that, what are the steps you should take? First of all, you should rank the debt in the order of their cost. It means, suppose if you have got 5 loans, a housing loan, car loan, and credit card loans, expenses loans. So you have to, give priority. How? Credit card loan carries highest interest rate, so you should clear the credit card loans first. Then your car loan is, they will charge very higher interest rate, and then comes your housing loan. Okay, so you have to set a priority like this. You have to make a list and you have to rank it. Suppose if you have taken a debt for raising an asset, any long term asset, and you are getting a loan at a lower interest rate. Let us say you have already taken a loan from one bank X and you are giving a rate of interest of 6%, and another bank tries to offer you the same loan, transfer of the loan at 5% interest rate with some prepayment charges. You should consider the prepayment charges and see whether it is feasible. For short term loans, this shifting of prepayment may not make much of a difference, but if you are having long term loans, it makes sense to shift from a high paying loan to a lesser interest rate loan. So in case, suppose, let us say that you have taken an appreciating asset, but you feel you are getting the pressure of monthly EMI. So what you can do is you can increase the tenure of the loan, and thus you can decrease the monthly EMI amount. Now, what are the important concepts of debt servicing requirements? See, servicing of debt means you have to uh, pay back the debt. But for paying back the debt, first of all, you require somebody to give you loan. But giving loan by banks are usually determined by your CIBIL score. CIBIL is one of the credit rating agencies. There are other credit rating agencies like Experian, CRIF, Highmark, and Equifax. You can consider any one of them, but CIBIL is the very popular credit score agency. See, this credit bureau is basically licensed by the Reserve Bank of India, and they are governed by the Credit Information Companies Act. Now, the financial health of an individual is basically assessed by the CIBIL score, which he is holding. Anything above 785 is considered good. Okay. See, this CIBIL score is calculated based on what? How many loans you are having, whether you are repaying the EMI regularly, and how much proportion of the loan which is eligible for you have utilized. Suppose if you are eligible for a 50 lakh loan, based on your income and annual income, if a bank mandates that you can take 50 lakh loan, since your income is annual income is higher, then you should not use all 50 lakhs, but you should do use less than 50 lakh. That means your in debt to income ratio should be less, which I have explained in the second slide. Now, how do you get a credit score? Very simple. Take as much less loan as possible. Your debt to income ratio should be low, and thirdly, you should pay your EMI regularly. Okay. Especially your score gets devastated, or basically gets spoiled because of your credit card loans which you are holding, and if you do not pay the credit card minimum amount regularly. Now, there is one important thing people miss out is you should be very careful while buying loans, that is secured loans and unsecured loans. You should strike a balance between a secured loan and an unsecured loan. Secured loan means you have to give collateral. Suppose if you have a housing loan, so your house will be mortgaged, then only bank will give you loan. Similarly, if you buy a car, you have to keep the car in the name of the bank which has given loan, and once you clear the all the EMIs, then only the car will come back to your name. Otherwise, it will still remain in the name of the bank itself. But there are some banks which give unsecured loans, so you should strike a balance. But unsecured loans usually will be a little bit costlier compared to secured loans. How to assess your credit score is very simple. Most of the people do it. You can go to online to any credit rating agencies and take the your credit score. And the credit score, the RBI mandates that is RBI has set a rule that most of this credit score which should be given by the rating agencies free of cost. And also, if there is any discrepancy in the details mentioned, that is the number of loans which you have taken, the EMI which you have given, is there is discrepancy, you should be able to raise a query against that CIBIL agency or any credit rating agency, and the credit rating agency should correct it also. So these are all mandated in the Credit Information Act of the government of the Reserve Bank of India. So this credit rating agency usually have the data about the last 3 years of the loan repayment history. Usually, the credit rating is given from January to December. So the credit rating agency, while giving information to you, generally authenticate. You have to authenticate with the credit rating agency that you are the person who is asking the information about a particular account. Then only they will give you loan. Now let us understand certain very important terms related to debts and loans. The first is very important thing, amortization. See, there are no parallel Hindi words for all this, so it is better we understand these words. Amortization means the capital which you have borrowed, that is going to be returned over a period of time. Suppose you buy a loan of 20, you avail a loan of 20 lakh, and including the interest rate, there is an EMI calculator. So they calculate, the company or the bank will calculate the EMI and say you have to pay 50,000 every month for so many years in order for your loan to complete, along with the interest rate you are supposed to give it to us. This is known as amortization. That is dividing the loan amount plus the interest due into equal monthly payment is known as amortization. There will be a schedule made by these are all calculators available. You can calculate your own EMI. I will show you at the end of this lecture how to calculate the EMI using an Excel sheet. See, the EMI amount, that is equated monthly installment amount, consists both of principal amount also and the interest amount also. See, whenever you repay the loan, at the start of the repayment of the loan, suppose if you are paying 20,000 as the EMI, usually 60 to 70% of the amount will be deducted towards your interest, and only 30% of the amount go towards the principal amount. So let us say you have taken a loan of 20 lakh and your EMI is 20,000. So in the earlier days, till about, if your loan tenure is about 100 months, so till about 30 to 40 months, your principal amount will be higher. Generally, it will be around more than 50%, 50 to 60%. So what does it mean? Out of 20,000 EMI, 12,000 will go towards interest and only 8,000 will go towards the deduction in your principal amount. That is, you have to understand this, and it is very important. So as the loan tenure starts coming down, so your principal component will start increasing in the EMI, and the interest component will keep coming down. That is natural, because initially they have taken more interest. So as the day passes by, they will take less interest, and more amount will be credited to your principal amount. Now coming to refinancing. See, refinancing is basically done because of two reasons which everybody knows. If one bank is giving a lesser interest rate than the other and it is lucrative, including the prepayment charges, we generally go for the refinancing. And second method is, suppose if the EMI which you are paying you feel is too high, and in such case you go for refinancing with a lower EMI and higher tenure. See, if you have longer tenure of the interest rate, then it will have a very higher impact on the interest which you are going to pay. Now coming to pre-EMI interest, this happens when generally people who buy a flat. See, what happens is the builder will ask you for regular payments to be given to him till the construction is completed. In such cases, what happens is you will be paying interest only to the amount of money which you have taken from the bank, not for the complete amount. Suppose you say I want a loan of 50 lakh. Bank say yes, we will give you a loan of 50 lakh. But in the first 1 year you will take 10 lakh. Second year you take another 10 lakh. So in the first year you will be charged interest only for 10 lakh, not for the 50 lakh. And when the second year, if you take another 10 lakh, the bank will charge interest for 10 plus 10, 20 lakh, and not for the 50 lakh. So the interest amount will be charged only for the amount which you have withdrawn from the bank out of the total 50 lakhs which is sanctioned by the bank. So once the complete amount is taken, all 50 lakh, then they will give you an EMI amount. So that EMI amount you have to pay regularly, which consists of both principal and the interest. Now let us understand some of the terms related to loans. Now coming to the moratorium. First of all is moratorium. See, moratorium, we have generally understood what is moratorium. because most of the younger generation have gone through the COVID pandemic. During COVID pandemic, since the company, most of the companies were closed for almost 1 year, 90% of the big banks gave moratorium to the people who have taken the loans. They said for the next 5 months or 6 months you need not pay any EMI, and we are not going to charge penalty for that. Not we are going to consider that you have defaulted on the payment. So I think some most of the banks give a moratorium of 6 to 8 months to all the people who had taken the loans, whether it is car loan or housing loan, so that they will not be affected with the default penalty or the default risk. The next is mortgage. See, mortgage is very common. Mortgage is a concept wherein, suppose you want to buy a house. Bank will say, okay, we will give you 50 lakh loan for the house which you are purchasing, but the house will remain in the name of the bank. Suppose if you are taking loan from the State Bank of India, State Bank of India say, I will give you 50 lakh. Please, that the house will be in the name of the State Bank of India. Once you finish the loan, the bank will give back all the original documents, and you can get the house transferred in your name. So this is known as mortgage. This is a common concept. Most of the people, 99% of the housing loan is raised like this only. Now there is something called as pledge. Let us understand what is pledge. See, pledging is basically considered for the movable assets like automobile, and mortgage is basically for the immovable asset. Now, here what happens is the property will be with the lender, till the time the loan is cleared. Suppose you pledge something, you can pledge gold, you can pledge your car, you can pledge your house also, and you raise a loan. So once you raise a loan, that property will remain with the person who has given the loan till the time you clear the complete amount along with the interest. That is known as pledge. Just in case if you are unable to clear the loan, the person can sell the property and retrieve the amount which he has given to you. That is called as pledge. Now coming to hypothecation. Hypothecation is similar to mortgage, but the only thing is the property here in case of hypothecation will remain with the borrower. Suppose if I have taken a housing loan and I have hypothecated my house, but I can still stay in the house, but the documents and the house will remain in the name of the bank. So once you clear the loan, the bank will return your document. So that is known as hypothecation. Now coming to fixed rate loan, there are two types of loan. One is fixed rate. The bank will say 6% and it will not be changed even though the MCLR gets changed. That is marginal cost of lending rate changes. They will not change the. So this fixed rate loan is very good during the low rates, low interest rate scenario. You can take loan at the low interest rate scenario and fix the interest rate. That is called as fixed rate loan. Now variable rate is it is also called as floating rate. Most of the people where there is long term loan usually opt for floating rate, where the interest rate depends upon the marginal cost of lending for the MCLR, marginal cost of lending rates of the bank. So it is very profitable if you take loan during the high interest rate scenario, but you should go for the floating rate. Now something called as home equity loan. Home equity loan is taken basically by mortgaging your house. And finally we have something called as hire purchase. See, hire purchase is nothing but it is a method of owning a property like car or machine. So what you do is you make an initial down payment, and subsequent payment for this car or automobile will be made through installments. Once the installment is finished, the individual who have taken the hire purchase will become the owner of the property. Lease. Most of the people go for lease of houses. What do you say? You say I'm going to stay in the house for 3 years, and the total amount which is to be paid is 20 lakhs. So the person who has given the house will keep that 20 lakhs and earn interest out of it, and you don't have to pay any rent or anything. And after 3 years, the 20 lakh amount will be returned by the owner, and you will release the property. But you should understand that nowadays a lot of fraud is going on as far as lease is concerned. Once the lease is finished, most of the owners will not have the money which they have taken from you, and that is going to be very very difficult for people who are on a transferable job. Now, coming to the loan calculation. See, loan calculation is done with the help of Excel sheet. Mm, there is something called as a PMT, which is a Excel formula. It is readily available. You can have a look into that. And in PMT we have nothing but A, B, C means, that is, one is the A is the interest rate. Interest rate, suppose if you have got 5% interest rate, you should do 0.05 divided by 12. That becomes the interest rate, because you are calculating interest rate on a monthly interest rate, not annual interest rate. 5% is for the entire 12 months. However, it has to be calculated for every month, means 0.05 divided by 12. And B is the tenure of the actually no B is the loan amount. If you see the PMT formula, this is written wrongly here. B is the loan amount. So suppose if you have raised a loan of 20 lakh, you have to write minus 20 lakh. And C is the tenure. Tenure should always be in months. If you have taken a loan for 5 years, the tenure should be written as 60 here. If you do that, you will calculate, you will get the what is the total EMI. We can go to the Excel sheet, and I will show you how to do the calculation. Next is you can know the principal component also using the interest rate calculator. That is done through a formula known as PPMT. So what is PPMT? Where in PPMT ABCD, we have A as the interest rate, B as the the month in which the principal amount is to be known. Suppose if you are on the second month, if you want to know the what should be your principal amount which will be deducted when you are paying an EMI on the second date, second month, then it will show the principal that is going to be deducted out of your EMI for the second month. I will show you in the calculation. Now you can also know the what is the principal component of a loan. So that is, I think it has doubled up. This is the total concept. Now with this things in the with this knowledge, generally I will be very sure that you will be able to take a good decision as far as your loan management is concerned. Now let us consider how to have various strategies to reduce your loans or debt faster. The first strategy is called as the avalanche strategy. What is avalanche strategy? You will pay the highest interest rate loan faster. The first, suppose if you have got a housing loan, and you have got a car loan, and you have got a credit card amount, you have to pay for 5 lakh or something. Since credit card incurs highest amount of interest rate, you should clear your credit card bills faster, and you should put all your effort in clearing all your credit card bills. So, but in doing so, you should understand that in avalanche strategy, this first part you are going to consider should be the major part of your loan portfolio. Now the second is the snowball. In snowball concept, the basically you want a momentum in your repayment capability, and you want a feel good feature also. Here what you do is, you are going to rank the loans which you have taken from lower interest rate and lower amount to the higher interest rate and higher amount. So you will clear all the loans which are of the low whatever the cash available with you. You are going to clear all the loan amount which are small loan amount, and then you will start clearing the higher loan amount. So this actually generally give a sense of achievement that you have cleared 2 3 loans, even though the amount may be 10,000, 20,000, 15,000 loans which you have taken. So that will generally give you a feeling, good feel that you have cleared those loans. Now there is a blizzard strategy. See, blizzard strategy is basically a mixture of avalanche and snowball strategy. When you apply this blizzard strategy, initially you go with an avalanche method where snowball method, where you are going to clear all the small loans, and then you will go with the avalanche method where you will take the highest interest rate loan with the highest portfolio proportion, and then you are going to clear that loan first. So these are the various concepts as far as debt management and loans are concerned. Now let us go and calculate the PMT and PPMT. I will just show you. It's very simple. Okay, what we shall do is we'll go with this and we'll create a new. Okay, now what I will have is, one is the interest rate. So interest rate is, what should be the interest rate? Suppose if interest rate is 8%, what I will write? 0.08, right? 0.08 as the interest. But this is for the entire year. So what I will do, I divide it by 12. So you will get an interest rate of 0.006. Now after the interest rate, what should be your this thing? It should be your period. Suppose if I say I have a period of 120 months. So 120 months is what? 10 years. And thirdly, I say loan raised. So loan raised is your, let us assume that it is given as present value in the formula. Okay, we will write as present value only. Present value, let us say you have taken a loan of 50 lakh. Okay, unit tens. Okay, unit tens, 100,000, 50 lakh. Okay, now with these values, what you are going to do is, I will do a calculation here. See, if I write PMT and press enter, see it gives periodic rate. So what should be the periodic rate? This is the periodic rate. What is the number of period? This is the number of period. What is the present value? Present value, this should be the present value. But what I will do is, present value. Future value you don't have to put. It is not very relevant. So if I put this, and here you should understand that I have told you have to put it as minus 50 though. So if I put minus 50, so the EMI which you have to pay will be 60,663 per month if you have raised a loan of 50 lakh for 10 years at an interest rate of 8%, isn't it? We have put 8%, so 8 divided by 12 it has come. So your EMI will be 60,000. So suppose if you want to know your principal amount, okay, principal amount, right? Now principal amount. So for principal amount, what are you doing? You're doing something called as PPMT, right? So if I write PPMT, it says, before that what we will do is we will write one more number of period. No? What is the period you want to know the principal amount? That is first month or second month or fifth month, what should be the principal? So for that we will go back here and write PPMT, and if you enter, so periodic rate will be same, period will be 120, number of period will be here. Okay, present value is 50,000, future value is 0, and when due means where it is the the interest you have to pay in the initial month or the end of the month. That is not relevant, so you can just keep it like that. Now here I suppose if I want to know the principal amount which I am going to pay from my EMI. Suppose you have got an EMI of 60,000. No, in this 60,000, how much money is going to go to the principal amount second on the second month of your loan repayment? If I put that, you will get a, see, this is D5, right, interest rate, and this is D6, 12, present value, D4, number of period, D4, future value, and this thing P50, this is due. Okay, let us see what is the reason for this. We'll redo it. Okay, what we'll do is we'll redo it. Okay, now PPMT, if I write PPMT again, suppose if I write PPMT again and click, so periodic rate, you click here and this will come. Period, you say 2, number of periods, how much, 120, present value minus 50, future value and when due you don't have to put. See, out of the 60,000 EMI which you are paying, on the second month of your loan repayment, your principal amount will be 27,000, and your interest amount, suppose if I say interest amount will be what, this minus the principal amount, that is the interest amount. So you are paying more interest amount, that is 33,151 will be your interest amount, and 27,512 will go towards principal amount. So this is how you are going to calculate using a simple Excel sheet. Okay, I hope you have understood. Thank you very much. Have a nice day. And if you want to know more about the, all the subjects related to the basically MBA aspirants and the BCom aspirants, I have got lot of lectures in my financial planning playlist. You can go and have a look. I will put the link in the description. Thank you very much.